Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach analysis and trading at Trading University. First market we're going to take a look at will be the Australian US dollar. Aussie hit resistance last week. We talked about that. Really hasn't been able to recover here. The macro problem for Aussie is China. True, the Aussie has stabilized, and yes, that area around 69.20 is worth looking at. Strong support down there. On the other hand, that may just mean you need one more rip down, one more probe lower before we take a serious look at this guy. Next market, dollar Swiss. Love this chart. I think you got to look at it longer term. We call this the trade of the decade in here. Right in here, right? The trade of the decade. Then we were referring to the investment of the decade once it got some legs on it. Well, guess what? It came right back. Well, not quite. It's a little bit above that level that we said we loved. So, if we loved it then, we love it even more right now. Heck of an opportunity right here in the Swiss franc. Can't say enough about that. We think there's a ton of room on the upside. Go back to the daily chart. Last week we said, referring to the dollar, this is the area you want to step up and you want to use leverage as well. And nothing's changed there. We love that market in that area, dollar Swiss. We like U.S. dollars overall. And here, there's a lot of uncertainty in the global economy for sure. The one region that's held up pretty well has been the U.S. overall. And we think the one region is about to pick up again will be the U.S. heading into the spring. Traditionally, you have a nice bump in growth in the U.S. in the spring, and that's just around the corner here. So we still love the dollar, still love dollar Swiss here. Again, we were really beating the drum here. This is a great opportunity to get long in here on this dip, and we see it again, same opportunity. Sure, you have all these shorter and intermediate term patterns, but you still have the significant secondary and primary pattern up. We think that's a heck of a buy opportunity right now. Dollar index, same story. There you can see it. Look at that beautiful two-third retracement right on that longer-term trend line there. What can I say? We love this market again. If we really liked it in here, we love it there, and we think you got to deploy leverage as well. We don't see anything wrong with using a little bit of margin, a little bit of leverage there to maximize that. What did we say a couple weeks ago? That it's a fortune maker, and markets are, and we think this is one area on the chart where your risk is so low relative to the upside here. So you just have a spectacular risk reward at these levels. And again, that's the fortune maker we were talking about 2 weeks ago. You're getting it at quite a bit cheaper too. The market was almost perfect, came down to that support for us. So 2 weeks ago we called it the fortune maker. Last week we're saying, hey, deploy leverage. Same story, nothing's changed. Love dollars at this level. Euro US dollar, quite a rally here, quite a counter trend hiccup there, but right into the teeth of resistance. You can see just this Friday we had what we call a change of direction candle. Change of direction, you closed below the low of the highest closing candle. We'll see how significant that is. The only thing that would get me to back off shorting the euro here would be a weekly close above that level that you're looking at right there. Now that can't possibly happen for another week here. So, we'll see if this guy puts up a fight at that level. But if it puts up a fight at that level and at the end of the week it manages to close above that red line, 113.25 or so, then I have to say I'm a little too enthusiastic about that bear call there. And markets may have to consolidate a little bit more ahead of that big spring push in the U.S. economy. For now, however, we think this is definitely a level that you step out and deploy leverage at. And keep in mind, too, that if you're going to turn lower in a big way, you have to do it pretty quickly. I'd say you have about a week to get that turnaround in place and start to see lower prices. Otherwise, I'll have to back off a little and take another look at it at the next resistance level out. Likewise, the next support level if you're looking at the dollar and dollar pairs. Here's the U.S. stock market next. I think you have to look at this guy in a weekly chart. I started nibbling in my personal account in here Friday, and I like that. I like it because you have a double bottom. I was saying before I'd really like to see a test of 1750 or so in the S&Ps. That may be a little bit optimistic on my part. From my perspective, here's how I view this. When I say a little bit, I'm taking a nibble there. I'm starting to buy the S&P cash index. It's got a nice little dividend on it, and I don't mind if it goes lower. I don't mind if my timing's off here, because I think it's an index that you want to accumulate here over time. And the best way to accumulate a stock would be dollar cost averaging. So I'm not afraid of going in here and being early. Definitely not employing leverage here. I want to make that point. I'm not employing leverage in buying stocks. I'm going for that dividend. I'm really looking to accumulate it over time. So, hey, the best thing in the world would be if they continue to grind lower in there, I continue to buy it on a monthly basis or so, accumulate it, pick up that dividend. In the long run, pick up many, many shares so that when you get to the next upturn, I'm in a good position and I'm long. My concern here is that upturn could happen sooner rather than later, particularly with the big business rush we'll see in the U.S. going into spring as everything starts to pick up. Next market we'll take a look at will be the gold market. Well, I had a big rally in gold there. I've been a gold bear for a long time. I see it really as definitely a bear market rally here, short covering rally. Here's the thing about commodities, though. They always go further and faster than you think they can. That's why I tend to like the currencies more. They're much heavier traded. Gold, very small market compared to your stock markets and your currency markets around the globe. But, no surprise, it is a commodity. It'll overshoot. And on the other hand, you look at gold right now, and boy, look at that. You're getting a heck of a level to potentially short that guy at. And I don't often talk about deploying leverage in commodities, leverage in futures like that. But, again, if there's the time to take a look at it, take a look at it right here in the gold market. And, you have those smaller contracts. You have those 10-ounce contracts, too. But I think that may be something, those may be something to look at here. I think that's an excellent place to take shorts in that market. Gold in some cases a leading indicator market, but I just think it's reflecting short-term uncertainty, which is normal for this time of the year because everyone's holding their breath saying, hey, once winter melts into spring, are we going to see an economic pickup? I think it's pretty much a foregone conclusion that you are, particularly in the U.S., and I think that'll lead markets out of the funk that they're in now. Last market we take a look at will be U.S. 10-year notes, Treasury notes, interest rates essentially in the U.S. And let me pop out to a monthly chart. Here's a fascinating chart. This is the U.S. 10-year Treasury note. You can see it's right at resistance. It probed above it. You couldn't close above it. That's significant. On a monthly basis, you couldn't get above there. Again, very significant chart. Here you see the massive rally in treasuries as money came out of everywhere else in the world and went into the treasury market, starting with the crash of '08 and the stock market bear market, and just continue to pile in there. And really, it hasn't come out yet. For the most part, there's just a ton of money in treasuries, and that's lower interest rates. As U.S. treasuries trade higher, as they run higher, interest rates go lower and lower. When this market reverses, that's going to be an event for sure, because where's all that money going to go? Well, in the past, every time it came out of U.S. treasuries and went into the U.S. stock market, eventually, as this market reverses, it's going to mean higher interest rates. Eventually, you are going to see a normalization of interest rates in not only the U.S., but then that'll lead to globally. And that's where I'm pretty excited, and that's where I'm optimistic long term, because when people and businesses are finally relaxed enough to start to take that money out of there, they're going to start to invest it around the globe, and that's going to be a good thing. And that's overall why I've been so bullish on the dollar and so bullish on the U.S. economy too. Sure, you're going to have rough spots, but overall I think you have to stay the course. Hey, thank you so much. My name is Jay Norris. I teach market analysis and trading at Trading University, and I'll see you next week.